Do you understand your risk on every option position that you put on? Are you comfortable with the worst possible outcome if the absolute worst scenario happens? Now, these are important questions to ask yourself on a regular basis. In the Options Academy training room at NetPicks, we talk about maximum risk on every trade to make sure that traders are very clear about what could happen if the worst case scenario does play out. Now, recently there was a story covered an awful trading mistake by an Arizona stock trader who didn't ask himself the above questions about understanding risk, and he's now paying for that mistake in a really big way. The Arizona trader shorted a pharmaceutical company, KBIO, which is a $2 stock. He was looking for a quick scalp to the downside. After putting on the trade, he stepped away for a few hours to attend a meeting. When he came back, he noticed the stock was trading up over 500% to $12.56 per share. The problem was that his position had unlimited risk if the stock moved higher. So immediately, his position was down over $144,000. He was trading a $35,000 account with E-Trade at the time. Now, taking a look at the screenshots, you can see he was facing a margin call over $106,000. He now owes E-Trade more than $106,000 with no way to pay it back. He actually started a GoFundMe campaign to try and raise funds to repay the full amount. Now, we could talk about this one in detail for hours. However, there are some very important takeaways from this whole situation that every single trader should be aware of. So let's talk about them. Number one, understand your maximum risk before ever placing a trade. Now, we don't know if Mr. Campbell knew his risk before placing the trades or not. When shorting a stock, it's crucial to understand that you have unlimited risk. Sure, you make money if the stock moves lower, but you also have unlimited risk if the stock moves higher. Now, a stock can only go to zero, so his short stock position only had a $2 profit potential per share. And we also know that a stock can move as high as it wants, which left him with the unlimited risk. He assumed that his broker would take him out on such a big move before his account was wiped out. Well, the argument could be made that E-Trade should have done more to help him out, but in reality, it's up to us as traders to understand our maximum risk on each trade and put a plan in place to deal with that scenario when it comes up. Now, many new traders look to short cheap stocks because they can do so with a small account size. Now, as you can see with this example, it does not pay off to do so in the long run. There are much better products to use in place of shorting stocks to try and play the downside. Using stock options is a great alternative that will allow you to avoid the big risk that shorting stocks brings. Number two, trade with defined risk trade types. There are many reasons for option trading, and one of the top reasons is the ability to use defined risk in their trades. In the case of Mr. Campbell's short, he wanted to play the downside. Unfortunately, he placed a trade that only had $2 worth of profit potential with an unlimited risk like we talked about. Instead of shorting the stock to play the downside, we much prefer to use a strategy like a long put or a short call spread. These options trades would still provide great profit potential if the stock moves lower, but they also come with limited risk. We know what our worst case scenario would be before we ever get into the trade. In the case of a long put, we can never lose more than what we pay for it. In the case of his stock, it didn't offer options as it was only a $2 stock. So if you cannot take a defined risk position and know your risk up front, then don't trade the product. It's that simple. Number three, don't mistake using a stop loss as defining your risk. Many traders use stop losses as a false sense of security. They think that these orders will define the risk and leave them with a small loss if the position moves against them. And what they don't realize is that there are situations where the stop loss does you no good. For example, what if a stock makes a gap lower at the open the day after you put a position on? If that gap causes the stock to open past your stop, then you have taken a larger loss than you anticipated. Also, if you're not trading a liquid stock, then your stop order could be filled at a worse price than you anticipated. By the time E-Trade was able to close Mr. Campbell's short position, the stock was already trading another $2 higher than what it was when he first noticed what was going on. So you define your risk before trading. And as a trader, it's much better off using a product that allows you to define your risk before ever putting on the trade. Trading involves risk, regardless of the product that you're trading. Markets have an uncanny way of making people pay a big price when mistakes are made. I think we can all use this story as a reminder to understand the products and the risks associated with these products before we ever put our hard-earned money on the line. And I'm sure that Mr. Campbell thought his trade had the potential for quick profit to the downside. But the problems all started when he did not realize that shorting shares of stocks also comes with unlimited risk. Unlimited risk meant taking losses larger than his account size. Now he's facing a negative balance of over $106,000 as a result of not knowing the risk associated with his products. Trading can lead to very nice returns in a quick time frame, which is why we're all attracted to the markets. Like any other business, you have to have a plan in place for every situation. So don't make the mistake of using products or trades that you don't understand. If you use the tools and trade types that are available in today's markets, you can be an active trader using very safe trades. Trading options is a great way to be active in bullish and bearish markets with defined risk trades. So learn from Mr. Campbell's mistakes and focus on defined risk trades so this story is not repeated down the road.